Why do you think secondaries are particularly attractive to the private wealth investor?
I think there's a couple of things. Number one is performance. Investors love not having to wait 5 years to get that capital account statement to see positive performance.
Is this more episodic in the sense that, the stars have aligned and that's why we're seeing such fast growth? Or is this something that really irrespective of whether the M&A market is hot or not, that you're going to just see the continued growth in secondaries?
There's that element of performance, but there's also a lot of portfolio benefits too. I think number one on the list is, and this is becoming a bigger topic for LPs today, is diversification.
Right.
It is a capital-constrained market, and I don't think a lot of folks out there know that and appreciate that, but that is what has us most excited about the market today.
One word to describe the current private market environment.
Rapid.
The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions.
Welcome to episode 6 of On Point, a podcast from Element Point Family Office. Today, I had the great pleasure of speaking with Ryan Cooney, Managing Director from Hamilton Lane, a leading alternative asset manager. We took a deep dive into the secondaries market, what's driving the spectacular growth we've seen, and why secondaries are great for investors. I hope you enjoy today's episode. Ryan, welcome. Thrilled to have you as our guest on the On Point podcast. So, Ryan, we have an audience, some of which are sophisticated investors and others really don't know that much about the private market. So I thought where we would start was, can you give our audience a little background on Hamilton Lane, the company you work for, what your role is there, and the secondaries market, since that's really going to be the focus of today's discussion.
Yeah, no, absolutely. So happy to be here and thank you for having me. I always love talking, regardless of the level of sophistication. I always love talking about private markets. So maybe I start with a little bit about Hamilton Lane. And we would have to go back, 30 plus years to understand how we started and where we're positioned within the private markets ecosystem. And the best way I can describe it is, let's say on one side, you have the general partners. So these are the fund managers. And some of them are household names that you and others know, like Blackstone and Apollo. And then there's thousands of others that you may not be familiar with. And on the other side, you have the limited partners. So those are the investors. And those limited partners are trying to figure out how to access those general partners in the private markets. Hamilton Lane sits squarely in the middle of both of those groups. Our customers are those investors that are trying to access those general partners. And for over 30 years now, we've been helping those limited partners access the private markets and those fund managers. And back then, it was more of a kind of consultant driven business for us. We were working with many well-known large institutions here in the U.S., and we're basically helping them manage their private equity portfolios, in addition to accessing and allocating capital. Today, we still do that. It's core to our business, but we've helped and evolved our investors with that through many different products. We do it through customized separate accounts. We do it through data and technology, which is a huge core area of focus for us as an organization and one that we've really leaned into over the last couple of years. And so that's really what we do. We today have 22 offices globally, continuing to expand our global footprint. We are based just outside of Philadelphia, so that's where we're headquartered. We've got, I think we're going to be close to 800 people maybe by the end of the year, early part of next year in terms of employees. And I think one of the more important stats about us, in addition to that footprint, is just the amount of capital that we're allocating on an annual basis within the private markets. So when you add it all up, we're deploying on behalf of our clients a little over $30 billion each year into the private markets.
It's a large number.
It is. It makes us, if not the one of the largest allocators in private equity today. And so we could talk more about that and what that means, but that's kind of really who we are. I started at Hamilton Lane back in 2008. So I've been at the firm for over 17 years. 2008 was an interesting time to start anywhere. I think the door slammed behind me as I walked in, but really interesting time. Still very early in the life of private equity in the private markets. I learned a tremendous amount during that time period and really carried that with me through my career at Hamilton Lane. Today, I sit within our secondary platform. And majority of the time I've been at the firm, I've been dedicated to our secondary business. And that secondary business today, when you kind of look at that, we are one of the most experienced secondary teams out there in the market. We've been active in the secondary market for over 25 years. The senior folks that we have on the team today have basically worked together at Hamilton Lane since the inception of the secondary market. So we've got a lot of cohesiveness and experience. And we're, as a platform, we're assets under management on the secondary side. We're a little north of $25 billion.
So just for our audience, can you describe what a secondary is? Because I think there's probably some either misconceptions or maybe just some of our audience may not even know what a secondary is. So
yeah, absolutely. So a secondary in its simplest form is the transfer of a private equity interest or fund from that original investor to a new investor. And so let's say, for example, Carlos, you are a very prestigious college endowment here in the U.S. And over the last 30 years, you have built a very nice private equity portfolio. You may have 50 private equity positions in your portfolio today. And for many different reasons, you want liquidity. And if you want that liquidity, it's not easy to get in private markets. Because by nature, private markets are a long-term asset class. They're illiquid, but the secondary market can help you get that liquidity. So you would go to the market as that endowment. You would work with a group like us, Hamilton Lane, who in this case would be the buyer. And you're probably not selling your entire portfolio, but maybe you're selling a select few of funds out of your portfolio. You would work with us. You would negotiate a price with the buyer, and we would then ultimately replace you as an LP in those funds. So you get out of those funds, you get your liquidity. We step in as the replacement LP, and then we basically assume obligations, capital calls, distributions going forward. But that's really the core of this market. That is, your traditional, what we like to call LP interest secondary transaction.
Right. And obviously the market has evolved over the years, and now anywhere from 50% of the market is what's called GP-led transactions, otherwise known as continuation vehicles, or is there a difference between the two?
Yeah, they're kind of one and the same.
One and the same.
Yeah.
Taking a step back, because I think it's interesting with respect to Hamilton Lane itself. You guys from the beginning were involved in secondaries, or is that sort of an evolution of, the practice of advising LPs on accessing GPs, primary business, if you will, or did the secondaries business sort of evolve from that?
It evolved from that. I mean, we started as an organization in 1991. I would say we first started doing secondaries on behalf of some of our discretionary clients in 2000. Okay. And when you look at the world back then, there were challenges within a lot of limited partners private equity portfolios. And we had this just because of who we are and what I described earlier of kind of being smack dab in the middle of that ecosystem. We had this front row seat. We're seeing more investors come into the private markets. We're seeing allocations increase in the private markets. But that challenge that they had was if you needed liquidity, it was tough to get. On top of that, you had LPs, limited partners, going through the dot-com bubble. They were going through the GFC. And so there was just a ton of challenges that were happening. The secondary market back then in the early 2000s really rose to that challenge and emerged to handle a lot of those questions and challenges that limited partners had in their portfolio. And so the secondary market back then was really being built off of liquidity pressures and, market cycle challenges that limited partners were facing. You use the word evolve. It has evolved tremendously, over that 25-year history. And I would say back then, and we can get into this more, but the sellers in the market, those limited partners that were selling their private equity positions, were 100% distressed. So those sales, the motivation behind those sales was because they were distressed. There was stress happening. And it was also kind of this dynamic where if you were an institution and you were selling in the secondary market, that meant that there was a problem. So there was this negative connotation around it.
Right.
And today that has completely changed. It is much more of a proactive, opportunistic portfolio management tool that exists within the broader private markets. And I think that's probably one of the biggest evolutions that we have seen. But back then we really saw the market being built off of some of those challenges.
Right. And having you guys as a big allocator of capital within the private equity world, you were privy to a lot of data on each GP, on their investments, on their funds. So it puts you in the perfect position really to be a buyer of these LP interests, right? And that's I think you've built an entire database going back 25 to 35 years that you've been in the business that has helped you become an astute investor in secondaries. And I think it gives you an advantage over potentially others who don't have that big primary business. Would you agree with that?
Yeah, absolutely. You hit it. I can't emphasize enough how important having information, particularly in the secondary market, really provides you with some benefits and powerful advantages. And we've always had this data and information as an organization, as a firm. Today, we've got, hundreds of thousands of underlying companies and assets that we're tracking, over 60,000 active private equity funds that we are getting financial statements on, and cash flows and NAVs. We've always had that as a firm. But I would say over the last 10 to 15 years is really where we said, okay, it doesn't matter if you just have it. What really matters is what you do with it.
Right.
And so that's where I think we've been ahead of the curve in terms of building tools that our investment platforms can use to be quicker. They can be smarter. They can have better insight. That's the data side of it. That's the quant side of it. There is a qualitative part of our data and information in the four walls of Hamilton Lane that I think is also valuable. And those are just conversations and touch points that we have with general partners. So I looked at our investment team's calendar this week, and we've got 60 to 70 individual meetings with general partners just this week alone. I'd say that's probably an average week.
Right.
So some of those are annual meetings. Some of those are update calls, catch-ups, LPAC seats. That provides tremendous amount of flow of information that you're not going to get in a quarterly financial statement. And so it's really kind of marrying the quant and the qualitative stuff together and leveraging that to be bigger, faster, stronger on the data side.
Fantastic. Now, listen, secondaries have become one of the hottest growth areas in private markets. And it's amazing because, as you referenced, going back to 2000 and 2008, it was really like distressed sale. That was the connotation. And today, It's one of the fastest growing areas of the private markets. And look, it's driven by rising hold periods, the lack of distributions we've seen from LPs receiving very few distributions. We're not, the M&A market has been somewhat challenged. IPOs, which is more relevant to venture, but in general also hasn't been great. So where do you see this going? Is this more episodic in the sense that, the stars have aligned and that's why we're seeing such fast growth and interest in the secondaries market to solve a particular problem that exists today? Or is this something that, really irrespective of whether the M&A market is hot or not, that you're going to just see the continued growth in secondaries?
Yeah, I think there are challenges that are happening today, and you hit on a number of them that within limited partners portfolios that are a little bit episodic. The hold periods, for example, that you referenced, GPs are just holding assets a little bit longer. They, relative to the last 5 to 10 years today, they are taking longer to maximize value and ultimately take that company and exit at a good return. And on top of that, you've got the NAV in the private markets continues to rise. So today we're sitting on north of $15 trillion of unrealized value in the market. Sitting here, me as the secondary buyer, I look at that chart and I get excited because that's our inventory as a secondary buyer.
And let's compare that. What's the dry powder on the secondaries that you estimate?
Yeah. So if you take the NAV that's exist out there today in the private markets relative to the deals that are actually getting done in the secondary market, the secondary market only represents 1% to 2% historically of that overall private markets NAV. So it's still a pretty small percentage of the overall market. But in addition to the distributions being a lot slower and all of that, I think that the LPs have caught on to the fact that this is a way to dampen and alleviate some of that illiquidity concern within their private markets portfolio. We see today a lot of pruning exercises. So they're not using the secondary market to say, I'm done with private equity. I need to sell this entire portfolio. It's more of a portfolio construction exercise where they're saying, you know what? These aren't our core managers anymore. Let's sell those. Let's get some liquidity so we can redeploy that capital into maybe some newer managers or venture that we've never been into or growth. So it's much more proactive mindset. Yep. It's not distressed, to be honest with you. And I think the LPs are utilizing it to their benefit. What we do see, and this kind of speaks to your question on where is this market going, we see a lot of first-time sellers in the market. So we saw a ton of first-time sellers last year that sold. That's really encouraging to us because that means that this is becoming more entrenched. It's becoming a bigger tool in the market. And there's not a lot of good data around this, but let's just assume that of all the sellers out there in the secondary market last year, maybe there was 300, 400 sellers. Well, there are thousands and thousands of limited partners out there in the world. Right. So what if that number just jumped from 300 to 500 or 700? So it's a repeatable market. We continue to think it's going to grow and be utilized proactively by LPs and GPs, which I'm sure we'll talk about. And so that's one of the reasons why.
If you're an LP and you're thinking about selling, like what do you recommend? Like, where should they go? Should they speak to a firm like you directly, or like what's the process for an LP to think about this and to execute on a potential transaction?
There's a couple of different ways to do it. We would love for you to talk to us, of course. And that happens, a lot actually in the market. We've got on the sourcing side, we've got individuals on our secondary team that basically wake up in the morning, pick up the phone in their email and contact hundreds of limited partners all over the world. And they basically say, hey, I know there's some liquidity pressures in the market today, or maybe we're over allocated to private equity in certain areas. We can be a liquidity solution for you, us, Hamilton Lane. We've got a lot of experience here. We can kind of give you off the shelf pricing. And so those conversations are very fruitful to our sourcing engine, and it generates a lot of potential opportunities for us on the sourcing side. There's also an element of the market that is heavily intermediated. And so there are basically bankers out there that exist in the secondary market. They're also referred to as brokers.
Yep.
That, going back to that endowment example that I shared with you earlier, if you want to sell your portfolio, you can contact one of those brokers, and that broker's job is basically to take your portfolio to 25 secondary buyers and try to get the best price possible. The brokers are really the lifeblood in terms of deal flow in the secondary market. So you have a couple of different options here if you want to sell, but we obviously are biased, prefer the one-on-one conversation without the brokers, because the broker world is a little bit of an auction type of process. And from the buy side, that can get competitive.
That's tough. Yeah. So just putting some numbers around the secondaries market, at least data that we've seen suggests that the market last year was about 160 billion of transactions, which was a doubling over the last 4 or 5 years. This year, we're on pace for over 200 billion, it seems like. So do your numbers suggest that's accurate? And then also, what does your deal flow at Hamilton Lane look like this year? And I guess as you go forward, what do you see?
Yeah. Those numbers are, I think, pretty telling to where we might end up by the end of this year in terms of volume. I think it's going to be another record year in the secondary market. But you bring up a great point, and that's the deal flow. So volume, when we're talking about the growth of the market, volume only scratches the surface. The real indicator of growth in the market is the deal flow. So that are the deals that we're seeing, that we're diligencing at the very top of our deal flow funnel. And so last year we reviewed just over $270 billion of deal flow. This year, I just checked this morning, and at the beginning of October, we are at $300 billion of deal flow that we've reviewed for this year. So we've already surpassed last year. We're going to end up in a spot where it's going to be another record year in terms of deal flow and volume. And I think it just kind of speaks to the importance of this market and the acceptance of this market, across both limited partners and general partners today.
That's fantastic. And then what do you find most attractive about the market today? Is it the fact that there's just so much deal flow and not that much capital, relatively speaking, to service this deal flow, and so you can be really selective? Are there some other elements of the market that you really find attractive today?
It is a capital constrained market, and I don't think a lot of folks out there know that and appreciate that, but that is what has us most excited about the market today. I mean, you just use the numbers that we just walked through. So $270 billion of deal flow that we saw last year, $160 billion of that got done in the market. And so the gap between what we're seeing and what's actually getting done in the market is about as wide as it's ever been. And when you look back over the last 5 years, that has been the case. We are seeing 2 times of what's getting done in the market. Now, there are a number of reasons why not every secondary deal gets done.
Right.
Sometimes it's quality. Sometimes it's pricing. The seller and buyer just don't see eye to eye. But the number one reason is that there is just not enough capital out there to take down all of that supply. We love that. That creates, as a buyer, that creates a very interesting supply demand dynamic. We think it decreases the competition and really allows us to pick our spots.
Right. So we've spoken about the incredible growth of the secondary market over the last, 10, 20 years. A big driver of that has been what we referenced earlier, the GP-led secondaries or continuation vehicles. So I guess, can you give our listeners an example or explain what a GP-led secondary is? Because that's a development that happened, it's different than when an LP looks to either rebalance or sell their portfolio or some portion of their portfolio. Can you tell them what is a GP-led secondary? Why did this part of the market even come about, and why is it being used? Why has it been the big driver of growth over the last 5 to 10 years?
Yeah. When I started in 2008, the GP-led deal in the secondary market didn't even exist. And so it definitely has evolved. It's 50% of the market today. That 50% is larger than the entire secondary market going back to 2016, 2017 time period. So it has really seen tremendous amount of growth. And the GP-led deal, another name for it is a continuation vehicle. And so what this deal is let's say we've got a 2013, 2014 vintage private equity fund. Let's call it a buyout fund. And typically these funds have a 10-year term life. And so that 2014 fund is now coming on that 10 years of its life. And in that fund, you might have one or two assets that just not have been sold yet, that haven't been exited. And so the general partner, instead of force selling that before they've been able to really maximize value in those companies, has created this continuation vehicle concept. So what happens is you've got existing investors in that 2014 vintage fund. The general partner goes back to those investors and says, we're right around our 10-year fund life. Things should be winding down. We've got these two assets remaining in the portfolio. We're giving you two options as an investor. You can cut bait, get out, get your liquidity, and we all move on, or you can transfer your interest over into this continuation vehicle, and we'll continue to manage those assets in the continuation vehicle, hopefully to a really nice return and exit someday. And so we, Hamilton Lane as the buyer, would come in and capitalize that new continuation vehicle. It injects a little bit more capital into that. But the general partners will still manage those assets. It's not like we come in and manage them. They will manage them. And the investors really get some optionality. If they have a true belief in those companies and want to continue to maximize the return, they can stay in. Majority of the time, what we see in these deals is that the existing investors in that fund get out. They take the liquidity. They say, thank you very much. We've had a nice ride. We'll lock in our returns and get our liquidity. So that's a continuation vehicle. I think the reason why it has grown so much in the market, in the secondary market, being 50% of the overall volume today, is a couple of different things. I think that the GPs have caught on to the fact that this allows them to hold good assets a little bit longer, where they don't want to have to force sale it. It also provides liquidity to their investors. And today we're seeing a lack of distributions on the private equity side. And so the GPs are wanting to get that liquidity to their investors. I like to simplify the GP-led deals two ways. Number one, it's a GP that really believes in the company. It's a great company. It just has had enough time to maximize that value and return in the construct of a 10-year fund. And so the continuation vehicle gives them a little bit more of that time. And then two, it's a GP that's holding on to an asset, and maybe they have failed at selling that asset the regular way. It's not a great asset. It hasn't grown the way that the GP had hoped to. And so we think that's more of a bad motivation. Yeah. We obviously like number one, and being in touch with these general partners all day long, we get a really good view and insight into that. And we spend a tremendous amount of time on these deals trying to understand the motivation, but that's really the market today, and it's grown.
So when was the first GP-led deal done, and who did it? Like, I don't really know that much about sort of the history of like how this idea came about, and, you know, I'm sure there was some pushback from LPs or. Yeah,
I think when the market started, and I would say it was somewhere between, I think the first deals that were getting done in the market were somewhere between 2010 and 2012 time period, maybe a little later than that. I think a lot of folks were somewhat negative. And again, it was kind of met with a little bit of skepticism, why the GP was doing this. Then you started hearing about some of these deals failing in the market, and they were getting titled zombie funds. So you can't kill a zombie, you can't kill a private equity fund. That was that whole reference and analogy back then. But that has completely shifted and changed. I would say we see, going back to the motivation today, we see better motivation, better alignment in these deals between the GP and this new continuation vehicle. We're seeing better terms and then just overall better quality in the market. And so we think that this is going to continue to be an important part of the secondary market, and it's going to continue to grow. But like most things in investments, didn't start off on the right foot. But I think today we see some really interesting opportunities at that end of the market.
Yeah, look, and the cynic in me sort of gravitates to some of maybe the negative things about the GP-led market. I mean, if you think about it, like if you're 10 years into a fund and here's this asset, if it was such a great asset that was in high demand, you would think that maybe the GPs would have sold it, crystallized, their carry, obviously helps the mark on their existing fund, and it helps with future fundraising. So I think a lot of the negative connotation was certainly, what is the motivation? I think that's such a huge driver of whether this is, a deal that you should be involved in or not. So my curiousness, I guess, since this is a newer part of the market, is there enough data out there to suggest that, a lot of these deals actually are good deals to step into? Like, do you have enough data today to say, these are high returning deals and we want to keep doing them? Or is it still a little bit of like a wait and see how things turn out?
We're starting to get that data. And I think the early indication on some of that performance is pretty positive. We've done GP LEDs in our funds, going back to 2015, 2016 time period, really when the market was starting to ramp up. And that track record is performing really well today, both on a realized basis and an unrealized basis. But it's taken a little bit of time because, again, these are companies and assets. The typical continuation vehicle the duration is 4 or 5 years. We've had to wait a little bit, to really identify where some of these were going to shake out. But I would say the early read is pretty positive on the performance side. I think the other thing to mention while we're on this topic is the investors also are paying close attention from the buy side. And I think some of these investors are saying, am I going to commit capital to this general partner's next fund and have to wait 6 to 7 years before I start seeing a return? Or am I going to back this continuation vehicle where the GP is basically doubling down on this with their own capital and their own conviction, where I might see a return in the next 3 to 4 years? So there's a little bit of duration mindset with these. And we've seen a lot more investors come around on this concept of it. And I think that's going to continue too.
So you said something interesting there where the GP is doubling down, and I guess it gets towards the point of alignment. Are you saying, I know it's prevalent that they roll their carry, but are you saying that you are, in many of these deals, and perhaps one of the requirements you have, I don't know, is that they bring in fresh capital into the company so that they're sort of reinvesting in the business at that current valuation?
That's right. Yeah. So I think the rolling the carryover, whether it's 75% of the carry or 100% of the carry, is basically table stakes at this point when we're negotiating, because we're negotiating with the general partner on the terms of this new continuation vehicle. And I think we see as Hamilton Lane, big player in the market, we can really benefit from that position and negotiating some attractive terms on that GP led. And we've seen those terms get better, but table stakes, the carry has to roll over. That's alignment piece number one. Alignment piece number two is we will also ask the general partners, the key senior people at the firm, the fund managers, to come out of pocket and invest their own personal capital into that continuation vehicle. And to us, that's ultra alignment of interest. And it also is telling too. Like this is a people business at the end of the day. So if the GP is willing to come out of their own pocket to invest again into this company, that's a good sign that they've got some pretty good conviction behind the asset.
For our listeners, what is the return you're targeting for, I guess, at the fund level, at a secondary fund level? And is it different whether it's an LP secondary or one of these continuation vehicles, or are they the same?
Yeah, they're a little bit different in terms of return profile and things that you probably need to consider as an investor. So on the return front, our portfolios are typically, 50% LP interest deals, and the other 50% is a mix between some of the GP leds and more complex structure. The blend of that, what we're looking to achieve in our funds is, high net teen IRRs and anywhere between a 1.6 and a 1.7 net multiple. And those are all unlevered returns. When you break out LP deals versus GP-led deals, GP-led deals have a tendency to be a little bit longer duration type transactions, and they're very somewhat concentrated in an asset or two. And so what we typically see is higher multiples because of that duration play on the GP-led side. So we've seen multiples, in the 2x range on some of these GP-leds. A lot of our investors have started using the word higher octane secondaries, which we think is kind of interesting. And then on the LP interest side, you're typically seeing, you could see returns on a net basis in the 20s. That multiple will be a little bit low of what we see on the GP-led side. The other big performance metric that we pay close attention to is the DPI. So DPI is the distributions that you receive out of that deal divided by the paid in, or what you invested. And we typically see much more rapid pace of DPI and the LP interest deals relative to the GP leds. So that is a function of when we are stepping into these funds on the LP interest deals. So we're typically buying funds and stepping in somewhere between years 4 and 7 years. That's right when that private equity fund is hitting its harvest stage. So that portfolio has been built. We have visibility on what that portfolio looks like. Those companies are now positioned for exit, and we're starting to see some liquidity sooner on the LP interest side than we do the GP led side. So it's really the big difference is multiple and DPI.
Multiple DPI, duration of investment.
Yeah.
Got it. We've seen some well-known endowments this year, like Harvard, Yale, come to the secondaries market and have sold some pretty large portfolios. What's driving that? And do you think we're going to see a lot more of that? Or was that sort of, one-off rebalance? Or, obviously I think the tax situation for some of these endowments, there was I think they did end up changing the tax rule, right? They raised their tax.
Yep.
So, but, I guess help us unpack that. And how did those transactions go? Was one firm was able to complete that transaction, or are those portfolios so large that it's really a consortium of firms that need to participate? Help us unpack that.
Yeah. So I think, when both of those endowments, very large endowments, started hitting the headlines in the press around these sales, it was right around, the beginning part of this year when, the administration was changing. And then obviously we hit kind of Liberation Day in April. And I think that created some overblown noise. The reality is that these endowments, who historically have very high allocations to the private markets within their portfolios, have always been big sellers, have always utilized the secondary market to their benefit. I think it was the Yale portfolio that was being sold in the beginning part of the year. I think a lot of people attributed to the change in the administration and some of the stress points that some of these endowments in the U.S. would feel. The reality is that sale had been long in the works well before January, and when the administration handed things over and changed. So again, I think there are stresses today that we see. We've actually done a lot of deals with endowments and foundations in the past. I think that's a little bit of a function of what those regulations are getting, what those institutions are getting hit with from a regulatory standpoint. But I also think that those institutions have always had very high allocations to private markets, and they're just using it like the rest of the market to their benefit and reducing some of their positions or rebalancing some of their portfolio.
Going back to the early days of secondaries, which were when they were LP secondaries now, but all secondaries, I guess, were they were generally distressed transactions, which means that the seller was getting a fairly low price for what they were selling relative to NAV. But discounts still remain a key part of the market. It's just not as prevalent as they were back then. But can you talk about pricing in the market today, how that fluctuates over time? And then secondary to that is, how important are discounts to achieving your target returns?
Mm-hmm. Yeah, great question. I mean, discounts are a big part of the market, and a lot of our investors really focus on that discount, rightfully so.
And I guess even unpack what even a discount is for those who may not even understand.
Yeah. Well, I mean, its simplest form, because we're buying used private equity funds, so to speak, or more mature private equity funds, we're typically buying those at a discount to the NAV at which, the investors holding them at. We've, over our 25-year, just to kind of level set, over our 25-year history, we've achieved discounts in the 15 to 20% range. That's through many different market cycles, but on average, that's kind of the range. And you're right. I think in distressed times or recessionary type periods, we often see much larger discounts happening on the secondary market because those sellers are in a bit of a position where they're forced to sell because they've got liquidity concerns or they're becoming over-allocated. We saw that in 2022, where a lot of these institutions, their public portfolio was dropping significantly. Their private equity market value was basically bumping along in a straight line, and that caused them to be over-allocated to the private markets. And so those institutions couldn't go to their boards. If they had a 10% target allocation to private markets, they couldn't go to their board meeting the next month and say, hey, guess what? We're at 13%. The board wouldn't be happy. The board would say, well, you got to pare some of that exposure back. And so we saw a lot of sales then. And that's more of a forced sale. Mm-hmm. And we typically see better pricing in those market environments. That said, when pricing drops in the secondary market, we also see volume come down. There's less transactions happening in the secondary market because a lot of those investors, if they can afford it, will hold on to those private equity funds. They don't want to sell them at big discounts. And so we kind of see that correlation happening between pricing coming down and market volume coming down. I think today, this was an interesting year because we got to April and the markets fell off quite quickly, and we were able to buy some really attractive opportunities then at 25% discounts. The pricing in the market has come back up and has been a little bit more stable. So I think we're seeing pricing today, for a good high quality buyout fund in the market, in the low 90s, sometimes higher than that if it's a really high quality fund. What we're trying to do in terms of pricing, and this is where the value arbitrage in the market exists. So we're looking at deals right now that we're pricing off of a 630 NAV deal. And we're underwriting all of those private equity funds where we have 630 values in. It's October today. That deal is not going to close into our portfolio until December. So there's a 6-month window of time here where we're trying to exploit that. And through the information that we've talked about, that we have at Hamilton Lane in our insight, we're trying to buy funds not only at good discounts, but funds that we think are going to be written up in the near term. So many times we're working with a seller and we may agree to pay that seller 90 cents and for that portfolio of funds. But in that 6-month time period, while we're waiting for that deal to close, maybe a couple of funds get written up, or maybe there's a significant realization or exit. We, as the new LP in that fund, are obligated to get that. We absorb that. And so when it closes, that could mean that it closes at a discount of 85 or 80. And so optically, what we pay the seller might be different from the time that it closes. And that is the pricing game, the discount game that you play in the secondary market. All that said, discounts are important. But what we feel and what we have really been hanging our hat on over the last 25 years of investing in this market is the quality of what we're buying. So we've looked at our track record, we've looked at our returns, and we have found at the end of the day that 70% of our returns are coming from post-purchase appreciation. So the appreciation of the assets and funds after we've bought them. And then 1/3 is coming from that discount. So it's important.
Right.
We don't want to pay a price that we're going to regret. And it actually helps early on with some of that performance in secondary funds. But at the end of the day, our performance is driven by the quality of what we're buying and the value that's being driven there.
Yeah. And I hear that over and over when I talk to secondary general partners, because I think it's easy for less experienced investors or managers to, fall in love with a discount and think, because, you buy something at 30% discount and you can mark it up pretty quickly and it looks great on paper. But if those aren't quality assets over time, they're not going to appreciate, or you may not even realize what they're marked at.
That's exactly right.
Which is not an outcome, obviously, that investors want. So
that's exactly right.
I think that's a very important point. One of the big trends we're seeing, and really that has happened in the private markets over the past 5 years, is the rise of evergreen funds. And so for our audience, especially in the private wealth channel, which is where we sit, I guess for our audience, can you give us a quick overview of what an evergreen fund is and what impact, if any, has it had on the secondary market? Because it is a strategy that we're seeing more and more turn into an evergreen structure. So love to hear your thoughts on that as well.
Yeah, I think the most common form or common funds or vehicles in the market today for investors is more of a traditional drawdown fund, where let's say you commit $1 to that drawdown fund, and over the next 3 to 4 years, that dollar gets called down gradually, and you're probably getting, 80 cents of that dollar or 90 cents of that dollar at the ground at the end of the day. Different in an evergreen structure, where if you commit that dollar, all of that dollar goes into the fund on day one. It's semi-liquid. So you can redeem out of that fund, and the funds have different lockup periods and other terms, but it's different than being kind of in the construct of a drawdown fund, where that fund has got a 10-year life. And you're basically in it for 10 years. The semi-liquid evergreen vehicle really allows investors to come in, get all their capital invested very quickly in the ground up front, and then they can redeem, when they really want to, outside of the terms of the fund. And so, and mostly there are, basically in a drawdown fund, you get distributions sent back to you. In an evergreen fund, typically distributions can get recycled to help do more investments, and that all compounds returns for you as an investor in the evergreen. It's 1099 tax reporting. There's a many different benefits in evergreen structures that a lot of private wealth clients like, and they're interesting. It feels like today, it feels like every firm out there that we talk to has an evergreen fund. It's growing rapidly. I don't know if we've seen a material impact on the secondary market though, just yet. The secondary market is pretty concentrated in 10 to 20 groups that have been in this market for a very long time, like us. And they probably make up 80% of the volume in the secondary market today. So some of those firms like us have launched evergreen funds to help satisfy some of that demand on the private wealth side, easier type fund to gain access to and invest through. And it's really just another solution for those investors. But it's really concentrated. And we don't see a lot of new entrants in the secondary market as well. It's the same groups over and over again.
Because I wonder if that'll change with the evergreen funds, but
I think so. But if you and I went out tomorrow and said, we're going to start an evergreen fund, a secondary evergreen fund, we would be disadvantaged on day one, just because lack of track record, obviously, but no relationships, no access, no information, no data around this market. So I think there's some very high barriers of entry to this. Mm-hmm. You and I, Carlos, individually don't have a lot of evergreen experience either in terms of managing these portfolios and thinking about liquidity management and inflows and investing that capital and how it impacts returns. So groups like us, we've done this for 6 or 7 years. We've got a 30-person team around that. So if we go out tomorrow and start this thing, we're going to fail before we start. So I think there's definitely some high barriers of interest, but we haven't seen it impact competitiveness in the secondary market. We go back to that supply over demand.
There's just such an imbalance that it hasn't really affected that yet.
Yeah.
When did you guys launch your secondary, your Evergreen secondary fund?
We've had a multi-strategy evergreen fund in the U.S. and then internationally, 2 separate funds. The one in the U.S. is a 40 Act fund. We've had that since 2019.
So when you say multi-strategy, you have secondaries, you have co-invest,
correct,
and primaries in there?
No primaries, predominantly, secondaries, co-investments. And then we have recently launched an exclusive secondary evergreen fund within the past year.
And how will does that fund just take a piece of every secondary deal the firm does? Or is it some deals go into that fund, some deals don't? How do you guys manage that allocation process?
Yeah, we've got a very tight allocation policy and process, particularly amongst some of these, our closed-end funds and evergreen funds. They basically sit side by side. So there's a lot of overlap there. Our closed-end business is larger than, our secondary evergreen business today. But we've got an entire allocation committee and portfolio management group that is doing just that, adhering to that allocation policy and managing the suitability of those accounts. But it's basically a lot of overlap amongst the different vehicles there.
And why do you think secondaries are particularly attractive to the private wealth investor?
Yeah, I think there's a couple of things. I mean, number one is performance. Investors love not having to wait 5 years to get that capital account statement to see positive performance. You get that.
Speaking as as an advisor who works directly with clients and having to wait 7 years to get your money back, or even 3 years, the J curve effect, right? Like for the first 3 years or 2 years, it looks like you're losing money.
That's right.
And you don't even really know how you're doing probably until year 4 or 5, until these companies really start to emerge and have transactions, get sold, et cetera. So it's definitely a challenge.
Absolutely. Yeah. So there's that element of performance, but there's also a lot of portfolio benefits too. I think number one on the list is, and this is becoming a bigger topic for LPs today, is diversification.
Right. You
look at the public world today, and on the public equity side, it's very concentrated. I mean, you look at your 401k, you look at anything else. I mean, you're basically relying on 7 tech companies to really drive your retirement today. And so in a typical secondary fund, I mean, you're getting access to hundreds of general partners, thousands of underlying companies, different strategies, different vintage years. And so it's really we think is one of the optimal ways to access the private markets in what we think is a less risky way. We think of secondaries as a bit of an all-weather strategy. And we've got some great data around how secondaries performed in up markets and how secondaries performed in down markets. And in both markets, the performance is really good. So you get some downside protection when, the market is a little bit concerning. But even in, times when the market is ripping up, like we've seen over the last 12 months, secondaries, outperform some of the buyout groups out there.
Yeah. Yeah. And the data we've seen suggests there's a real sort of consistency of returns that I guess you're speaking to.
Yes.
Which makes it, quite attractive. Lower duration, diversification, you get the vintage diversification, manager diversification. So, definitely a lot of benefits that we find clients are attracted to. And increasingly as we talk to other CIOs of wealth management firms, a strategy that is being used in client portfolios more and more. And I think on the institutional side too, I would imagine. I mean, you can speak to that, but, anyway, I'd love for you to kind of give us an example of 1 or 2 deals that you guys have done, whether recently or that you think highlight really what a typical Hamilton Lane deal would look like and what the differentiators are, just so we can have an idea of something like that.
Yeah, absolutely. So, I think you look at the profile of what we look for in a secondary transaction. It's a couple of different things, and we think this is where really we add value for our investors. Number one, we're looking to buy, very high quality funds through high quality general partners that are holding good assets, resilient assets that can perform through different market cycles. And then we're leveraging our GP relationships to access those companies and funds at a discount. And we're looking to find those companies where they may be exited in the near term. And so that's been really our consistent strategy over the last 25 plus years. How do we do that is really the question. And that comes back to the platform that we're very fortunate to have here at Hamilton Lane. And so maybe I'll give you a deal example. This will be an LP interest deal that we've done. And I would say advantages every step of the way of this process. But the overarching theme is just who we are, our platform, and why we're important in this market and how that can lead to some really interesting opportunities for us. So we were talking to a general partner, our primary team. We've got different investment teams at Hamilton Lane Platforms. Our primary team is basically underwriting general partners. So we see 1,500 new funds every year that come in through our door, and those general partners want our capital. And so we run a whole big diligence around that. We were talking to a general partner through the course of our, normal business. And that general partner had indicated on that call that there was a couple of companies that might be exited in the near term within the next, 8 to 12 months. And that no one on the secondary team was on that call. It was just our primary team. But we've set up a technology at our organization where an associate or analyst is typing up the notes of that conversation. They're putting it into the system, and they're flagging specific things that might be important to each of the different investment teams. So there's a section in that note section where it says, flag this to the secondary team. They put that in that section of the box, and we as a secondary team get this immediate notification and email. And on that notification, in this situation, the GP had referenced potential exits happening. So what do we do with that information now? Well, we do a little back of envelope type calculations, and we are finding that is a fund that we want to buy on the secondary market. It's an interesting inflection point. If that exit does occur, it's a double-digit increase to the overall value of the private equity fund. And so the first thing we do is we get back with the primary team that we sit right next to, and we say, hey, can we get on a call with the GP with you? We got on a call with this GP. We said, we can provide, liquidity to any of your investors if they're looking for it in the market. The GP said, thanks. They called us back a week later. They put us in touch with their largest and most tenured LP in their portfolio, in their fund, their investor. And now we have this bilateral conversation with that LP. They wouldn't sell us all of that fund because they were aware of the exit and they wanted to hold on to it, but they were over allocated to private equity. So they needed to sell. So they agreed to sell us half of that fund. But through that conversation that we're having with the seller, we now are looking at their entire portfolio, and they're showing us other funds in their portfolio. So we were able to create this deal by pairing other funds with that fund that we originally wanted to buy. Mm-hmm. We agreed to it. It ended up being a $300 million LP secondary transaction that got done through one note in the system that an analyst or an associate put in that sparked this whole off-market transaction for us. So I think it speaks to how interesting this market can be, how deals get created, but really back to the platform that we have here.
I was going to say, like, the proactive nature of the market today. I think it speaks to the depth and breadth of your platform and really, one of your reasons why you can win in this market.
Yep.
Because of that. Well, that's great. That's a great example. Thanks for sharing that with us. We like to end the podcast with some rapid fire questions.
All right.
That are,
I love it.
Fun for the audience. So, maybe a topic, not so much for secondaries, but just an investing topic today. Are we in an AI bubble right now?
Oh, Oh man, I wish we had our venture guy here for that, because you would probably get an amazing answer. I don't think so. I think we got a long way to go. I think you're starting to see some of the data come out on some of this stuff. And I think some of these companies are struggling. They're losing money on some of this technology, depending on the industry and sector. So my quick answer, sorry, I know this is rapid fire. I should probably more rapid. I do not think we're in an AI bubble.
Okay. Time will tell, obviously.
Yep.
What's the best advice you've ever received about investing?
Don't slow down a process by thinking that you need to get 25 different opinions on a deal. Use a little bit of your human being and your brain and your intuition. Gather the data, have the information, have the insight, do your diligence. But I think too many opinions sometimes can cloud certain
analysis paralysis, right?
That's exactly right.
Favorite investment book?
I'm supposed to say Barbarians at the Gate, just because of private equity. And I would encourage anyone that is thinking about private equity or starting their career to read that book. That's what I did. So I'll say Barbarians at the Gate. But I do travel a lot, so I do try to read. And I've been really into some of different presentation books, like educational presentation books, the art of the pitch. I love the kind of sociology behind that and thinking about that. So,
okay. Definitely not one we've probably heard before. So that's great. One word to describe the current private market environment.
Rapid.
Okay. And what keeps you up at night about the current market?
A lot of things. I would say in terms of the current market, we'll relate this back to the secondary market. I think maybe one area of concern is just on the GP led side. One of the things today that is difficult for GPs is fundraising. It's really tough if you're a buyout firm out there to raise capital. The LPs have a lack of liquidity. Distributions have slowed down. There's less flexibility. They're not getting those re-ups like they once were. Mm-hmm. And I get concerned that GP's motivation to do these continuation vehicles are going to be as a result of that lack of fundraising right now. And so I would say that was one area.
It brings to mind a comment that I think KKR made yesterday or this week, that there are more private market funds in this country than there are McDonald's, which is just remarkable.
I believe it.
Look, I think it speaks to the growth in private markets, but it speaks to, the challenges you're talking about, whereas some of these GPs are struggling to raise capital and they quite frankly might just close down,
Absolutely.
And then we'll end with a little fun one. What's your favorite city to visit and why?
Favorite city. So I'm a New Jersey native. And I'm fortunate to be in a position, at Hamilton Lane where I do get to travel a lot. And while I do love Jersey, I would have to say in the US, I think Chicago is a great city. I think that is a fantastic city. And then internationally, I do quite a bit of international travel. I don't think you can beat Zurich. I think that is a beautiful city.
I've only flown in and out of Zurich, so I didn't really get to spend much time there, but it's definitely Switzerland in general is an area that I definitely want to explore more.
It is it's a great country.
Ryan Cooney, thank you so much for sharing your insights on the secondaries market with us today on the On Point podcast. I look forward to sharing this with our listeners. Thank you.
Thank you very much, Carlos. It was great.
Thanks.
The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the hosts and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions.